If you're collecting Social Security benefits, you might have just received an extra $100 in your pocket without even knowing it. But here's the catch. It's not what you think it is. In this video, I'll break down the recent Social Security tax changes that are saving middle-income seniors an average of $100 per year, explain exactly who qualifies for these savings, and reveal why some beneficiaries won't see a penny of difference. By the end, you'll know exactly how these changes affect your specific situation and what you need to do to maximize your benefits. Welcome back to Financial Area, where we break down complex financial news into actionable insights. If you find this information valuable, hit that like button and subscribe for more money-saving tips and financial updates. Now, let's dive into what's really happening with these Social Security tax changes, because the headlines are telling only part of the story. First, let's clear up the biggest misconception floating around right now. When you see headlines screaming about a $100 increase for Social Security beneficiaries, your first thought might be that your monthly check is getting bigger. Unfortunately, that's not the case. This isn't a direct increase to your Social Security benefits at all. What we're actually talking about is tax savings. A new federal law was signed in early July that changes how Social Security benefits are taxed. And for many people, this translates to keeping more of their money instead of sending it to Uncle Sam. The average savings works out to about $100 per year for those who qualify. Here's where it gets interesting and a bit frustrating. The Social Security Administration sent out an email to beneficiaries celebrating this new law. But experts have pointed out that their communication was somewhat misleading. The SSA's message suggested that all taxes on Social Security benefits had been eliminated, which simply isn't true. The reality is much more nuanced, and understanding these nuances is crucial for figuring out whether you'll actually benefit. So what does this new law actually do? Instead of creating a blanket exemption for Social Security benefits from federal taxation, the legislation introduces a special tax deduction specifically for individuals aged 65 and older. This deduction is set at $6,000 per year for individuals and $12,000 for married couples filing jointly where both spouses are 65 or older. Think of it this way. If you're 65 or older, you can now subtract an additional $6,000 from your taxable income beyond what you could deduct before. This reduction in taxable income is what leads to lower taxes on your Social Security benefits, or in some cases, eliminates those taxes entirely. But here's the kicker that everyone needs to understand. This increased deduction isn't permanent. The provision is currently set to expire in 2028, unless Congress decides to renew or extend it. This means that while the tax relief is significant for those who qualify, it's only guaranteed for the next few years. This temporary nature is crucial for your long-term financial planning. Now, let's talk about who actually benefits from this change, because it's not as simple as all Social Security recipients save money. The primary beneficiaries are middle and upper-middle income seniors. According to estimates from nonpartisan organizations like the Tax Policy Center, individuals with annual incomes between $80,000 and $130,000 are expected to see the largest average tax cut, that $1,100 figure we keep hearing about. Why this specific group? Well, they often find themselves in what I call the tax gray area. They earn too much to avoid taxes on Social Security benefits entirely, but not so much that the new deduction gets phased out. For these individuals and couples, the increased deduction can make a meaningful difference in their annual tax bill. Let me give you a concrete example. Take a 68-year-old retiree with $90,000 in total income from Social Security, a pension, and some investment dividends. Under the old rules, they were paying federal taxes on a portion of their Social Security benefits. With the new $6,000 deduction, their taxable income drops significantly, potentially eliminating their tax liability on Social Security benefits altogether. That's where the $100 average savings comes into play. But here's what might surprise you. If you're a lower income senior, this new law will have little to no impact on your situation. Many low-income Social Security recipients already don't pay federal taxes on their benefits because their total income falls below the threshold where taxation begins. If you're in this category, you'll continue to pay no taxes on your benefits. just like before. The new deduction doesn't provide additional relief because you weren't paying these taxes in the first place. On the flip side, if you're a high-income senior, you're also unlikely to benefit from this new deduction. The law phases out the deduction for higher earners. We're talking about individuals earning more than $175,000 or couples earning more than $250,000 annually. If you fall into this category, your tax situation remains unchanged. This creates an interesting dynamic where the relief is targeted at a specific income band, those middle-income seniors who were caught in that tax gray area I mentioned earlier. Let's put this in perspective with some real numbers. Currently, about 50% of Social Security beneficiaries pay some form of federal tax on their benefits. With this new law, a significant portion of that 50% will see their tax burden reduced or eliminated entirely. But it's not universal relief. It's targeted relief for those in the middle. So what does this mean for your financial future? And what should you be doing about it? First, let's understand how we got here. Social Security benefits weren't always taxable. When the program was first established, benefits were completely exempt from federal income tax. However, in 1983, Congress passed legislation making up to 50% of Social Security benefits taxable for individuals with incomes above certain thresholds. Then in 1993, this was expanded to allow up to 85% of benefits to be taxed for higher income recipients. Here's the crucial part that many people don't realize. These income thresholds were never indexed for inflation. This means that over time, as the cost of living increased and people's other sources of retirement income grew, more and more beneficiaries found themselves paying taxes on their Social Security benefits. What started as a tax that affected only wealthy retirees gradually began impacting middle-class seniors as well. This is why the current change is so significant for that middle-income group. They're the ones who got caught in this inflation trap over the decades. Now, if you're wondering whether you qualify for these tax savings, here's what you need to do. First, calculate your total annual income from all sources: Social Security, pensions, retirement account withdrawals, investment income, part-time work, everything. If your total income falls between roughly $80,000 and $130,000 as an individual, or between $160,000 and $210,000 as a married couple, you're likely to see the most benefit from this new deduction. However, tax situations are complex, and individual circumstances vary widely. Strongly recommend consulting with a tax professional who can analyze your specific situation and help you understand exactly how the new deduction applies to your circumstances. They can also help you project whether you'll see a reduction in your tax bill and by how much. Here's something else to consider. Since this deduction is temporary and set to expire in 2028, you should factor this into your retirement planning. The reduced tax liability on Social Security benefits can free up more income for other expenses or savings, but you'll want to plan for the possibility that this relief might not be available indefinitely. Keep an eye on legislative developments over the next few years. There will likely be discussions about extending or modifying this provision as we get closer to the 2028 expiration date. Political promises about Social Security taxation are common, but the actual implementation often involves these kinds of compromises that target specific income groups rather than providing universal relief. Now, while we're talking about Social Security changes, I need to address something that's affecting everyone trying to get help from the Social Security Administration right now. Many beneficiaries have been experiencing extremely long wait times when calling the SSA for assistance, sometimes waiting hours just to speak with a representative. The SSA has responded to these complaints by temporarily reassigning about 1,000 customer service representatives from field offices to the national hotline. The goal is to reduce those wait times and make it easier for beneficiaries to get answers to their questions. But here's the problem. This creates a trade-off. By shifting staff away from processing claims and other essential work, the SSA risks creating backlogs in other areas. This could result in what experts call a vicious cycle, where work gets delayed, leading to more calls from beneficiaries seeking updates on their cases, which creates even more demand for phone support. The root of this problem is that the SSA is currently operating with historically low staffing levels. Back in 1967, there were 480 beneficiaries for each staff member. Today, That number has ballooned to 1,480 beneficiaries per staff member. This staffing crunch has led to increased workloads and longer processing times for many services. So what can you do to navigate this system more effectively? First, use the SSA's online resources whenever possible. Their website offers a wealth of information and self-service tools that can help you find answers to common questions, check the status of your benefits, and even apply for certain services online without needing to call. If you do need to call the SSA, be prepared for potential wait times, even with the recent staffing changes. Try calling during off-peak hours, typically early morning or late afternoon, and consider using online services when possible to minimize delays. Most importantly, stay informed about changes to Social Security policy and administration. These changes can happen quickly, and staying on top of developments will help you make better decisions about your benefits and financial planning. Let me wrap this up by putting everything in perspective. The recent changes to Social Security taxation represent a significant step forward for many retirees, particularly those middle-income seniors who have felt the burden of federal taxes on their benefits. The increased standard deduction will provide meaningful relief for millions, with that average tax savings of $1,100 for those who qualify. However, this relief isn't universal. If you're a low-income senior who already pays no taxes on your benefits, you won't see any change. If you're a high-income senior above the phase-out limits, you're also excluded from the new deduction. And with the provision set to expire in 2028, the future of this tax relief remains uncertain. The key takeaway here is that you need to understand your specific situation. Don't assume that just because you're receiving Social Security benefits, you're automatically going to save $1,100 in taxes. The savings depend entirely on your income level and current tax situation. My advice? Review your income and tax status. Consider consulting with a tax professional to understand how these changes apply to your situation, and keep monitoring legislative developments since this is a temporary provision. Remember, this tax relief is temporary and targeted. Make sure you're not leaving money on the table by understanding exactly where you stand. The new law doesn't eliminate all taxes on Social Security benefits, but it does provide substantial relief for many, and it marks an important development in the ongoing effort to support America's retirees. As always, beneficiaries should stay informed, review their individual circumstances, and seek professional advice to make the most of their Social Security benefits in this changing policy environment. If you found this breakdown helpful, make sure to hit that like button and subscribe to Financial Area for more in-depth analysis of financial news that affects your money. And let me know in the comments, do you think you'll qualify for these tax savings? I'd love to hear about your situation and answer any questions you might have.